Hi, I'm Keith McCullough. Welcome back. Today I want to answer a very basic question. Is the bond market right or is the stock market right? It's a really easy one to answer because I think they're both right if you look underneath the hood. Now, again, this is Hedge Eye style, so we'll do that in very simple form. The first thing that I want to show you is that the U.S. growth complex is slowing, specifically the consumer. You can look at this in three different ways. Number one, the Russell. The Russell's down 1.9% last week, down 4.8% for the year to date. Number two, the NASDAQ, which is a clean-cut growth index, is down 1.3% last week, down 2.5% for the year to date. And then the consumer, which represents 70% of the U.S. economy, on the discretionary side, is down 4.5% for the year to date. So again, what say you? There is no confusion here. The 10-year bond yield is not confused, again, with what's actually considered growth in the U.S. stock market. Growth is for sale, gone, no good, not what you want to be long. What you want to be long is basically the opposite of that. So let's look at that. What's working? Slow growth, low beta, and high dividend yielding stocks. Okay, that is the opposite of Facebook, Twitter, etc. Again, slow growth, low beta, high yield. That's the Dow Jones Industrial Average, by the way, if you look at it for what it is. And that is what it is. It's up. You know, it's not what the NASDAQ or the Russell is, which is down, just like bond yields are. So again, let's look at this in terms of style factors. Now, style factors would be a modern way of characterizing markets as opposed to just saying what the market feels like and talking about the weather and how you feel and I feel. Who cares? Again, look at the style factors underneath the hood. Very easy one. Slow growth stocks. So again, we're looking at the bottom 25%. And we're looking at it by S&P quartile. The bottom 25% in terms of earnings growers are up 5.2% for the year to date. Now that means that if you have a slow growth stock like IBM or Intel and you bought that, that's working. The high growth stuff, not so much. Low beta stocks are up 6.1% for the year to date. I mean, that is fantastic. If you own the high beta, by the way, and you're a hedge fund that put leverage on that beta, that's just called being long levered beta. That's not working in a low beta environment. So again, just think about it for what it is. We can't whine about it, misinterpret it, or say that the bond market doesn't get it. The market absolutely gets these factors. Finally, high dividend yielding stocks. Again, if growth is slowing, you're going to buy bonds or anything that looks like a bond, which would include high dividend yielding stocks, which are up a full 4% for the year to date. So again, bond yields have it right, and so does any slow growth yield chasing thing that you could get your hand on. All the growth stuff is for sale, and for good reason. If you have any questions about any of this, I'm at Keith McCullough. That's my Twitter handle.